Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at 6 different stocks that have increased their dividend for a very long time. They all pay dividends, they have a free cash flow. This is the sort of a company I genuinely will own right now in this kind of climate where there's so much uncertainty. The markets have been going down every single day. There are great companies like Amazon that's down almost 30%, Google's, the Microsoft, the Apple's, you name it, a lot of companies are down. The only companies actually that are doing really well is these companies, the energies, all right, and obviously healthcare and so on. So there are some great companies hidden away with, basically, okay. And this is the kind of thing you, as an investor, what you should be doing is focusing on quality companies that have a predictable income, companies that have increased their dividend for a long time, that are not going to cut it anytime. When a company pays a dividend, okay, or shares back or buys back shares, that means they've got free cash flow. That means they have basically money in the bank that they need to spend because they don't know what to do with it. They basically can reinvest in the business, they can buy back shares, they can actually give you some of it as a dividend, they can buy other companies, they can do whatever else, they do research and development, whatever it is, that's the money they can use. And some of these companies are what you need in your portfolio. You don't need, obviously you can have 1% of Teledocs and so on, but what you really need is a cash flow companies, okay? And we've always talked about that. Now, the first company we're going to look at is Home Depot. Home Depot is basically one of the world's largest home improvement in the US, currently trading $294 per share. EPS is actually quite high, which is very nice. Market cap of over $300 billion. And then you got white mode and you got capital allocation. Or when it comes to the capital allocation part, we're looking for, is this basically management actually using the money they get and allocating it in the right places, okay? So that's very important. Beta is quite low, so it's not as volatile as some of the companies out there. PE is quite low right now. In the sector is about 25.58 right now, okay? And right now it's actually only 18. I genuinely didn't think I would see Home Depot in this type of valuations right now. Price to free cash flow, again, just above 22, so 22.69. Enterprise value to EBITDA, 13.66. Dividends, look at this, how amazing this is, okay? 2.53% dividend, 5 years growth rate of 18%. Dividend growth streaks of 34 years. So that makes them dividend aristocrat. Payout ratio is quite low. Dividend safety, 87%. And they have $14 billion in the bank. Now, that is some in the money they can spend in all sorts of things, like I mentioned earlier. Okay. In terms of profitability, just above 10%, about almost 11% in terms of profit margin. Operating margins, again, very important, 15.4%. which we're looking for about 12. Return on equity, so much, 2050, okay, percent. Total returns in the last 10 years. That includes basically price appreciation as well as dividends. They return almost to 21%. And current ratio above 1, which is based. That means they have enough money to pay off their debt in the next few months. So the next 5 years, according to Yahoo Finance, this company is going to grow their earnings about 15%, which is very, very high for a company like this. This company is not a small company, but they actually are almost classified as a growth business. Simply Wall Street actually says about 15% undervalued at the moment. Their price target basically is $354 per share. Morningstar slightly says a premium, $255 per share. Tip rank, the 24% upside, and their price target is $373. And they say it's a strong buy. I believe it's a strong buy, and I will be looking at again to just nibble it, just to add a little bit more to it. I own in my portfolio, I think I own about 10 shares, and I would love to own more of this amazing business. And what makes it amazing is the fact that not only do they pay dividend, the amount of cash they have, and how profitable they are, and the growth in that business, and right now is undervalued. Morningstar obviously says it's actually overvalued a little bit, so you might want to wait a little bit and just to see if you feel like maybe let it drop another 5-7%, whatever. Okay, if you own it, then I don't think to me it really doesn't matter right now. I'm happy to average it up. I already have. I used to own 8 shares. I added 2 more shares, so right now I own 10 shares in total. Okay, right. So the next company we're looking at is Qualcomm. Qualcomm actually reported their earnings recently. This company, people used to say this company is all about the mobile technologies and all that stuff. They make chips for Microsoft and so on. Not anymore. They actually diversifying. They're doing things like the 5G, the Internet of Things. Okay, they are now number one. So when it comes to the what is it called? The S22 for the what's it called? The Samsung S22. They actually are. They increased basically their sales about 70% to Samsung, whatever. So they now heavy on Samsung mobile phones, but at the same time they're trying to diversify. They've already got 5G, Internet of Things, and million other products that they actually created. So they're not just focusing only on mobile phones. That's what I'm trying to say, right? So in terms of price, right now currently is $140 per share, EPS just below 10, market cap 156 billion. Okay, again, when it comes to an economic mode, I disagree this, by the way, because it says narrow here. I genuinely believe, because they have a patent for a lot of the things. They have so much patent, right? A lot of the other companies actually buy those patents from this company. So I don't think that's fair. I think it should have a wide mode. But again, what do I know? Basically, that's from Morningstar. Capital allocation is the standard. Beta is actually slightly high. PE very low. Price to free cash flow very low, and enterprise value to EBITDA kind of moderate. So again, when you look at this, you think it is cheap right now. Okay, annual dividend yield of just over 2%. 5-year growth rate 6%, dividend growth streak over 18 years, payout ratio 25. So that means they actually have a lot of room to increase these dividends if they wanted to. Dividend safety 80%, and they have $7.1 billion in the bank to actually do all of these things they want to do with the company. Profit margins, okay, we've got 27.7%. Operating margins 31% almost. Return on equity 107%. Total return of almost 10%, current ratio above 1, which is really good. And then everyone agrees on this one is about 15% and expected to grow. The earnings is expected to grow to about 15%. Simply Wall Street says it's actually 47% undervalued at the moment. Their price target is $264 per share. Morningstar fairly valued at the moment, 163. That's a bit moderate. I will say I think if this company gets a multiple of 20, maybe it will probably be hit at about 200 or above by the end of the year. Tip ranks are right now saying 40% upside. Target price is basically 196. I know it's a moderate buy. I will agree with them as a moderate buy for me. I will definitely be adding to this, but I'm not sure right now because I'm heavy on tech right now. So I've shared a video about my portfolio the other day. So if you want to know why I'm actually not investing in tech right now, okay, the technology sector, have a look at that video. Okay, but for me it's definitely a moderate buy. Okay, I will say this is a great company. Genuinely, I think in the next few years we will see this possibly would be hitting this $200 to $300 per share. So this is, for me, this is a long term. I'm not selling this. I'm going to keep it in the portfolio unless something crazy happens, God forbid. Right, so the next company we're looking at is Starbucks. Now, some people do say Starbucks is not actually compliant, but it actually basically Sharia compliant according to Islamically and according to Zoya and all of these companies. I've actually emailed Zoya not long ago, and they've actually said yes, it is, because I was worried they might actually sell products that are not Islamically compliant, whatever, but they apparently are. Okay, I don't own it right now. Okay, but it's one of the companies I'm looking at. There's a lot of issues with this company right now. Some union situation going on, China situation going on. Okay, because of the lockdowns and all that stuff. So that's why the price has come down, and I've included in this. So if you're interested, have a look at the company. If you're not interested, that's absolutely fine. Current share price is $76 per share. EPS 3.74. Market cap of $5 billion. This is one of the biggest companies when it comes to coffees, man. Honestly, seriously. Again, they have a wide mode, exemplary when it comes to capital allocation. Beta is below 1, which is what we want to see. P slightly, basically, well, almost what we were looking for. Again, price to free cash flow is the same. Enterprise to value is slightly higher. Okay, so this kind of tells me it's undervalued because normally I've not seen Starbucks actually trading about less than 24-25 for a very long time. Okay, so the sectors right now 25.58. So that's There you go. Annual dividend yield 2.63, 17 years or 17% of basically growing. Every 5 years, basically in the last 5 years, they grew this for about 17%, which is quite high. You don't normally see that. And this is one of the things that I actually included, one of the reasons I've included this in this video. Dividend growth streak about 11 years, payout ratio 56, dividend safety 67, free cash flow here almost $4.5 billion. So they've got enough money and they are actually increasing the dividends. Okay, profit margin about 15, operating margin about 16, return on equity I couldn't find it. Basically they've returned the last 10 years they've returned about 11.52. Current ratio we're looking for above 1, so that means they might get into debt, whatever, but they have, because of the free cash flow here, they should be able to pay that off if they needed to. Okay, the next 5 years they're expecting about 11.4% growth. Again, a company like Starbucks, you think is they probably growth 2-3%, 4% max, but it's actually 11.4%, which is really good. Okay, it's undervalued according to Simply Wall Street, and basically undervalued according to Morningstar, and undervalued according to TipRank. They all have different prices, but they very, very similar. 106, 106, 107. That's moderate buy from TipRank as well. So again, it's a great company. If you own it, hold it. If you don't own it, I mean, just look into it. Like I said, in terms of compliance side of things, it is compliant according to all these places. And I have not actually looked at their breakdown of their revenue, but I can't imagine anything in there that's going to be really huge, more than 5% like all they say. But have a look at that if you're interested. Next one is Union Pacific. This is one of the companies that I own in my portfolio. Is a railroad company, is in North America. Absolutely great company, right? Current share price of $229. EPS is just above 10. Market cap $147 billion. They have economic mode and their capital allocation is a standard. Right now, in terms of beta, they're actually quite low, which is very, very nice. PE just about above 21. Price to free cash flow about 24. Enterprise is actually slightly higher. So this kind of tells me maybe it needs to come down a little bit for us to include. This is actually one of the viewers actually asked me to look into this company. So that's one of the reasons I included in here. So I think it's a little bit overvalued at the moment, but let's see. Annual dividend of yield of what? 2%, 5-year growth rate of 14%, dividend growth streak of 23 years, payout ratio 43%. So that tells us yes, actually they have a room to improve that, and their safety is 88. They've got $6 billion in the bank if they wanted to do whatever they want to do with. Profit margin almost 30%, operating margins 43%, sorry. Return on equity 42, total returns about 16.62 in the last 10 years. Total returns, that's absolutely amazing, absolutely brilliant. That beats the market. Current ratio should be above 1, is lower than that, but the fact that they've got $6 billion in the bank, I'm not worried at all. According to Morningstar, Yahoo Finance, they expected the earnings to grow up by 16%. That's probably why it's expensive right now. Simply Wall Street says it's 6% undervalued, $250 per share. That's where it should be. Morningstar says 10% premium. Okay, $211 per share, 18% upside for TipRanks, and 277 is a moderate buy. I will say if you own it, hold it for now. Okay, I'm not adding to it. Okay, I'm definitely not adding to it until it actually comes back down at least a 10%, because I'm averaging it up. I'm actually up quite a lot, 21% up right now, so I don't want to average up. So for that reason, I'm just going to keep it in the portfolio. Right, so the next company we're looking at is Lowe's. Again, it's similar to Home Depot, largest home improvement retailer in the US, currently trading $192, EPS 12, market cap of 130, white mode, capital allocation exemplary. Beta is quite low, PE really low, price to free cash flow and enterprise to value is actually value to EBITDA is actually also low. Now, we're normally looking for anything below 10, but that's kind of okay-ish in my opinion. And right now, as I said, like Home Depot, the sector is actually 25.58, but right now we're looking at a P of 18, but by P of almost 16. Dividend yield 1.62, so it's not a lot, but they have room to improve. And if you look at how long they have, so in the last 5 years they grow about this 18% dividend growth streak of 59 payout ratio, 25%, dividend safety 93%, and they have $8 billion. Absolutely quality company, honestly. Just Home Depot and this company are absolutely amazing companies. Profit margins 88.8%. Okay, and operating margins about 12.7. Couldn't find return on equity. Basically total return 21. Can you imagine the last 10 years? That's basically what you would got, 21%. Okay, and the current ratio is above 1, which is what we're looking for, and everyone agrees it's actually undervalued at the moment. Okay, so or fairly valued at the moment. So next 5 years they expect to grow about 15%. Simply Wall Street actually says 31% undervalued. Fair valued according to Morningstar. TipRank says is about 31% upside. That they have different price ranges, but Morningstar is the only one that's actually fair value. The other two actually quite bullish, 31% each, and it's a strong buy. I definitely agree with this. Okay, definitely for me it's a strong buy. Although I'm quite up quite a bit, I'm absolutely basically adding to this company because I genuinely love this business. Okay, right. So the next one is Air Products and Chemicals, is the leading industrial gas supplier globally. One of the best companies I own in my portfolio. I feel like I'm talking about just my portfolio, but some of you are new to the stock company, to the channel, obviously. As well as that, I want to let you know some quality companies that are actually on basically that you could potentially add to your portfolio. Okay, I'm not a financial advisor, but I'm just giving you an idea of what you could potentially do. Current price is $235 per share, EPS about 10, market cap 51 billion. Economic modes are narrow and capital allocation exemplary. We're looking for beta that's below 1, and that is what it is right now. PE is a little bit high. Price to free cash flow is high because cash flow is not actually a lot. Okay, enterprise to EBITDA, okay, is actually not that big, but because of this, obviously that is just going to be low. Annual dividend yield of 2.77. Okay, 5-year growth rate of 11%. Dividend growth streak of almost 40 years. Their payout ratio 64. So again, they have a room to improve, so that's why I'm not worried, and that cash should be enough to cover that. And then dividend safety 95%, and that is percentage there. Okay, oops, there's another sign in there, whatever came from. Right, so profit margin almost 20%, operating margins 21%, return on equity 15%, return on total return in the last 10 years, we're looking about 12.76%, which is absolutely amazing. Okay, when you think about that. Okay, current ratio, we're looking above 1, that's 2.46. So that means they got enough money in the bank to cover their debt in the next 12 months. So no issues there. Next 5 years, okay, Yahoo Finance says it should be growing the business about 12%. Simply Wall Street, for some reason, thinks the price should be $1,320 per share. I disagree. Morningstar, 26%. That's moderate. That's all right. TipRanks, more or less the same. So these two kind of agree on something. Moderate buy right now as we speak. And I will say it's a basically moderate buy, but at the same time, because I'm down, okay, I don't mind actually averaging it down. I'm down a little bit. So there we go. I say little bit. It is actually a little bit. It's about 2%. 25%. It's for £75. Okay, and I've already invested £2,876 in that company. Right, so these are quality companies, and the reason I want to share it with you guys, okay, is because when you look at the overall market and you're like, oh my gosh, what is going on here? Everything is going down. But if you buy this type of companies, okay, they've been around for a long time. They've been paying dividends for like 34 years. Do you think this company is going to go out of business anytime soon? Absolutely no. Okay, so anything can happen to this business, but when they have $14 billion, they've got enough money to pay you and cover any debt they have, whatever, and the next 5 years the company will absolutely be fine. You don't have to worry about that. We might get a recession where everything slows down and people are not going to the markets and buying new products from Home Depot. No one's doing home improvements, whatever, but eventually the market will bounce back, and when it does, that's when you're going to benefit. If you're buying this type of company when they're down, you're going to benefit a lot when they're actually up. And that's my opinion. And that's basically me. That's what I'm doing. That's not financial advice. That's what I'm doing. I'm thinking, okay, I own 3M. At some point, it's going to bounce back. I know I've done my research. I believe in the company, and I'm going to carry on investing in that company and see what happens. Okay, I have my price targets and so on. So same goes for Lowe's. Same goes for Home Depot and any other companies in my portfolio. I hope you enjoy that video. If you did, please like, subscribe to the channel. Take care. Assalamu Alaikum.